How has the US stock market, in particular the S&P 500, performed in an election year? How does the election actually impact the stock market? And are there any indicators that you should be aware of for your own portfolio if you actually do invest in the United States? In this video, we'll break down some key statistics and findings that maybe are going to put your mind at ease or give you more anxiety. Of course, there's some indicators that we definitely need to look at, but the first one is, how does the election actually impact the stock market? And we have conclusive evidence on that front. Whether it be a Republican or a Democrat, the stock market usually responds very positively to the US election. In fact, since the S&P 500 began, there's been 23 election cycles, out of which 19 have seen a positive return. And this is not a Democrat versus Republican debate. For both presidential candidates, the S&P 500 has seen a positive return. If a Republican won the election, the S&P 500 increased by 15.3%. If a Democrat won the election, the S&P 500 increased by 7.6%. On average, there's a near 11.3% increase no matter what candidate won the election. If a Democrat was already in office and another Democrat was elected, the total return for the year was 11%. If a Republican replaced the Democrat, the return went up to 12.9%. On first glance, these returns heavily favor Republican candidates, but there's some other statistics that we need to look at before making a final decision. And that is the role of the House or the US Congress in all of this. Of course, the presidential election is important since the president makes a lot of big decisions, but a lot of results also have to go through the House or the US Congress. And if we focus on House control versus White House control, we see a more detailed picture of how the election impacts the stock market. In particular, if there's a Democratic candidate that wins and the Congress is also controlled by a Democrat, the average 3-month return of the S&P 500 during this election period is 2.2%. If the White House is controlled by a Democrat, but the Republicans control the House, meaning the outcome is divided, the average return is actually 3.85%. The best outcome is in fact when a Democrat wins the election, but the House is split, which leads to an average 3-month return of 3.93%. This shows you that the House is perhaps more important when it comes to a Democratic candidate winning the election. We can see the same for Republican candidates. If a Republican candidate wins the election, but the House is controlled by a Democrat, the average 3-month return is 1.19%. If a Republican candidate wins and the Republicans control the House, the average 3-month return is 2.67%. And if the Republican candidate wins, but the House is divided, the average 3-month return is 1.62%. So arguably the House, when it comes to both the Democratic candidates and the Republican candidates, plays a huge role in how the market perceives the election result. At the same time, we don't want to overstate the importance of the election, since a lot of data suggests that economic trends like inflation and economic performance when it comes to GDP have a stronger link to the S&P 500 and the stock market in general than election results. In recent years, the US has shown a strong economy. Even with high interest rates, GDP has outpaced initial growth, even avoiding a recession that many economists thought was going to be reality. And most data indicates that this is what the market looks towards most. When there's regime change or elections, the period the economy is in dictates the performance of the S&P 500 and the stock market in general. For example, in rising growth, when GDP is increasingly beating expectations, the 3-month return in the same period of election is 2.99%. In falling growth, this return falls 1.5% to a return of only 1.5%. The same can be said for inflation. In a period of rising inflation, the 3-month return is only 1.36%. In falling inflation, this return goes up to 2.7%. Combining both of these gives us the strongest indication of how the stock market is going to perform in the election cycle. A period of rising growth and falling inflation leads to a return of 3.52%, which is significant. On the contrary, falling growth and rising inflation leads to a return of 0.49%, the lowest out of all of these combinations. Now, we've analyzed presidential elections, but the other type of election that's common in the US is midterm elections. These elections happen in the middle of the presidential term and might bode well for the market overall. US bank investment strategists found that the S&P 500 consistently outperformed in the year after midterm elections compared with non-midterm elections. So if you're willing to make a bet on the market and looking to make some extra money, midterm elections, specifically the year after the midterm elections, might be a nice bet. And in these elections, much like the previous ones, who controls the Congress does not matter in the overall equity market's performance. Inflation matters and the economic growth trajectory matters. Now the question remains, since Trump recently got elected and took oath, how will this impact stock market performance? The S&P 500 had a significant year in 2024, being up more than 20% for the second year in a row. Economic indicators are strong, but the only two scenarios that contributed to absolutely positive returns in excess of long-term average returns for the stock market was Democratic control of the White House and full Republican control of Congress, or Democratic control of the White House and split party control of the Senate and the House. Since Trump is not a Democrat, we don't have statistical evidence of the absolute performance of the S&P 500 given past results, but we do know that the economy is in a strong state. Inflation is falling and economic growth is high, and those two factors remain much more important for the performance of the stock market rather than who's actually president. For long-term investors that are holding for 20 years or even beyond that, even if you buy at the peak of the peaks, for a 20-year horizon, those are going to be next year's lows. And research backs that. For the last 20 years, if you had bought the S&P 500 at its peak every single time and were the most unlucky person on the planet, you would still have an annualized return rate of 10.8%. Not bad. The lesson is, statistically and probabilistically, keep buying and holding. And 20 years from now, 30 years from now, you'll probably withdraw a whole lot of money. As always, smash the like button and the subscribe button if you enjoyed this video. Every subscriber matters and helps get this video to the right people who are also interested in money, finance, and learning how to save more. I'll see you in the next one.